When one of Wall Street's most successful hedge fund managers suddenly changes direction, smart investors pay attention. David Tepper built his reputation on one critical skill, knowing exactly when to zig while everyone else zags. His timing has generated billions in returns, and his recent moves suggest something major is brewing beneath the surface of today's market celebration. Just months ago, Tepper was telling investors to embrace the rally. His confidence helped fuel one of the strongest market runs we've seen. But his latest regulatory disclosures reveal a complete strategic reversal. While everyday investors continue pouring money into stocks at record highs, Tepper is building defensive positions that profit from market declines. This isn't a minor adjustment. This is a fundamental shift in outlook from someone whose market timing has been almost eerily accurate. So what changed? And more importantly, what should you be doing with your portfolio right now? Let's establish why Tepper's moves matter more than your average market commentator. This is not someone who predicts crashes every other month or changes his mind with each news cycle. Tepper's defining characteristic is patience combined with precision. Go back to the financial crisis. While the world was convinced capitalism itself might collapse, Tepper identified a simple reality. Central banks would flood the system with money, and that money would lift asset prices. He positioned accordingly, buying financial stocks that everyone else was dumping. The result? Billions in profits and a place in hedge fund history. Jump to recent times. When markets wobbled and recession fears dominated headlines, Tepper saw improving conditions before they became obvious. He publicly stated his bullish case and encouraged stock purchases. Anyone following that guidance captured substantial gains as markets surged higher. These aren't lucky guesses. They represent a consistent approach. Analyze liquidity flows, understand central bank policy, ignore emotional narratives, and position before the crowd catches on. When someone with this methodology makes dramatic portfolio changes, it creates a roadmap worth examining. Regulatory documents filed with the SEC provide a window into hedge fund positioning. Tepper's recent submission revealed notable changes that most mainstream coverage glossed over or missed entirely. The data shows increased put option exposure on both the S&P 500 and technology-heavy indexes. For those unfamiliar, put options gain value when prices fall. These aren't small hedges tucked into a corner of the portfolio. The scale suggests conviction about downside risk ahead. Simultaneously, Tepper has reduced holdings in the mega-cap technology names that have dominated market gains. These are the stocks sitting in virtually every portfolio, the companies that powered indexes higher throughout the recent rally. Tepper is stepping away from this consensus position. But here's what makes his strategy particularly interesting. He's not moving entirely to cash. Instead, he's rotating into unloved sectors and geographies. Regional bank stocks that crashed during banking sector stress. Chinese equities that have been abandoned by Western investors. These are contrarian plays on assets trading at depressed valuations. This positioning reveals specific expectations about what's coming. Tepper isn't just becoming cautious, he's preparing for a particular type of market environment where today's winners become tomorrow's underperformers and where despised assets potentially outperform. Understanding Tepper's approach requires grasping how he views markets fundamentally. While most investors obsess over company earnings or economic indicators, Tepper focuses primarily on one question: where is liquidity flowing? Think of financial markets like a system of connected pools. When central banks keep money cheap and abundant, that liquidity flows into risk assets. Stock prices rise not necessarily because businesses are performing better, but because there's more money chasing those assets. Conversely, when central banks tighten conditions and drain liquidity, the tide goes out across all markets. This explains Tepper's crisis-era success. He understood that Federal Reserve intervention would create a liquidity wave large enough to lift everything. Individual stock fundamentals mattered less than the macro flow of capital. Fast forward to today. The Federal Reserve raised interest rates dramatically over the past 2 years, the most aggressive tightening cycle in decades. While inflation has cooled, monetary policy operates with significant lags. The full impact of rate increases takes time to filter through the economy. Tepper appears to believe we're approaching the moment when those delayed effects arrive forcefully. Economic data is beginning to show strain. The liquidity that powered markets higher is being withdrawn, and when that reality becomes undeniable, asset prices adjust accordingly. Current stock market valuations present a mathematical challenge that Tepper is clearly factoring into his positioning. The S&P 500 trades at elevated multiples that assume continued profit growth and benign economic conditions. Here's the issue with expensive valuations. They leave little room for disappointment. When stocks price in optimistic scenarios, any deviation from that path triggers disproportionate declines. The higher the valuation, the further the potential fall. Consider what happens during economic slowdowns. Corporate earnings typically contract as sales decrease and margins compress. But the market doesn't simply adjust stock prices for lower profits. Investor psychology shifts, risk tolerance evaporates, and the multiple investors are willing to pay for those earnings also declines. This double impact, falling earnings multiplied by falling multiples, creates the conditions for significant market corrections. If earnings drop 15% and valuation multiples compress from current levels to recession averages, the mathematical outcome implies substantial index declines. Tepper's put positions target exactly this scenario. He's not betting on a minor pullback. He's positioning for the kind of reset that occurs when expensive markets meet economic reality. The assets Tepper is buying tell us as much as what he's selling. His rotation into beaten-down sectors reveals sophisticated thinking about risk and reward dynamics. Regional banking stocks were destroyed during recent financial stress. Many remain deeply discounted despite the worst fears not materializing. Tepper is accumulating these positions, essentially betting that the sector has limited downside after already suffering massive losses, while simultaneously being positioned to benefit from any government support if stress resurfaces. His Chinese allocation is even more contrarian. Chinese equities represent perhaps the most hated major market globally. Geopolitical tensions, regulatory concerns, and growth disappointments have driven investors away. Yet Tepper sees opportunity in this pessimism. The logic is classical value investing applied at the portfolio level. Sell what's expensive and popular, buy what's cheap and despised. This maximizes the margin of safety. Even if markets broadly decline, beaten-down assets have less room to fall, while stretched valuations have considerable downside. Tepper is also positioning for potential regime change in global markets. American technology dominance has been the winning trade for over a decade. But if economic conditions shift, or if other regions implement effective stimulus, capital flows could rotate dramatically. His portfolio structure suggests he's preparing for this possibility. When might Tepper expect his thesis to play out? Economic cycles follow patterns, and monetary policy effects occur with predictable lags. Rate increases implemented throughout 2022 and 2023 typically take 12 to 18 months to fully impact the economy. Companies locked into low rates eventually need to refinance at higher costs. Consumer spending patterns adjust as credit becomes more expensive. These effects compound over time rather than appearing immediately. Based on this timeline, the pressure points would likely emerge throughout the coming year. Economic data should continue deteriorating if Tepper's view is correct. Corporate profit margins would face compression. Market participants would eventually recognize the changed environment and adjust positioning accordingly. Of course, timing markets perfectly is impossible. Tepper might be early, He has been before, but his historical pattern shows he's willing to establish positions ahead of inflection points, then maintain conviction through near-term noise. For individual investors, the implications extend beyond market direction. Most retirement accounts and index funds are heavily concentrated in exactly the positions Tepper is reducing. The passive investing revolution has created unprecedented crowding in mega-cap technology stocks. If Tepper's scenario unfolds, this crowding could amplify declines. When everyone holds the same positions and market dynamics shift, the exit becomes congested. This is not a prediction of catastrophe, but rather a risk worth understanding and potentially addressing in portfolio construction. Tepper's positioning doesn't necessarily mean you should replicate his portfolio. Hedge funds operate with different time horizons, risk tolerances, and objectives than individual investors, but his analysis provides valuable perspective on current market conditions. First, take inventory of your current positioning. How concentrated are you in the same technology stocks Tepper is reducing? How would your portfolio perform if his downside scenario materializes? These aren't comfortable questions, but they're necessary ones. Second, consider whether your risk exposure matches your actual situation. If you're heavily invested at market peaks and lack sufficient cash reserves, a significant correction could force uncomfortable decisions. Building some cushion now provides flexibility later. Third, understand that strong historical returns don't guarantee continued gains. The past decade trained investors to buy every dip because markets always recovered quickly. But this pattern isn't universal. Sometimes markets decline substantially and remain depressed for extended periods. Tepper isn't operating on hunches or emotion. His approach combines macro analysis, liquidity assessment, and valuation awareness. When someone with this methodology makes dramatic shifts, it represents a data-driven conclusion about changing conditions. David Tepper's recent positioning represents more than routine portfolio adjustments. His moves signal a fundamental reassessment of market conditions by someone whose timing has historically been exceptional. The hedge fund manager who correctly identified the 2009 bottom and the recent rally is now preparing for significant downside. He's reducing exposure to consensus positions, building defensive strategies through put options, and rotating into contrarian value plays. Whether his latest call proves as accurate as his previous ones remains to be seen. Markets could continue higher despite elevated valuations and tightening liquidity. But Tepper's track record suggests his analysis deserves serious consideration. The information is now available to anyone paying attention. Regulatory filings provide transparency into his thinking. The question becomes whether you'll use this information to reassess your own positioning, or whether you'll maintain current exposure and hope his analysis is wrong. One of Wall Street's most successful contrarian investors just made a major directional bet. The only question that matters now is what you're going to do with that information.